Hey guys, it's Nick, and in this video I want to do an update on what's going on with Archegos. Some new information has come out about Morgan Stanley selling stock on the Thursday before the big sell-off. So it's just comical when you read about this on how these banks are just stabbing each other in the back and their so-called good clients, the hedge funds that they dumped this stock on. And also, it's come out that part of this whole decline might have been because Bill Wang didn't buy extra stock in the secondary offering of Viacom. It's come out that Morgan Stanley, who was the underwriter for the secondary offering of Viacom on March 22nd, offered a piece or was hoping that Bill Wang was going to buy a $300 million piece of that secondary offering. And Bill Wang backed out of it, possibly because a few of the Chinese tech stocks like GSX started going down a few days earlier. And so maybe he didn't have the cash extra to put into Viacom. And so ironically, him not buying that extra piece might have been one of the reasons why Viacom fell as much as it did after the secondary offering. Maybe people were seeing that they didn't get as much in the secondary offering as they were hoping to because of Bill Wang not putting up $300 million for that piece of it. At the insistence of Credit Suisse, Credit Suisse was trying to get everybody to hold off and not dump all at the same time, especially when they all got in the room and realized that they all basically had the same position, which magnifies the risk of selling that stuff. It's not like, Credit Suisse had Facebook and Goldman Sachs had Amazon or something like that. They all had the same 9 or 10 stocks concentrated in huge positions. So they knew that if they all went to sell at the same time, it would tank like crazy. And so they were trying to talk each other into holding off on for a little while. It's almost like the what do they call that? The prisoner's dilemma, where if you and another guy are accused of doing a crime, if you both shut up, then you won't be found guilty because they have no evidence. But if one of you squeals first, they get the best deal. And so that's what's called the prisoner's dilemma. Can you trust each other to both keep quiet? And that's why the police separate you and put you in separate rooms to try to talk you into ratting on the other guy. And that's kind of what happened in this meeting. So they're all talking nice about, yeah, let's hold off and this and that. And in another video, I said that Goldman Sachs was the first one to sell on Friday. It turns out that's not the case. Morgan Stanley sold a block of $5 billion of 9 or 10 of these stocks that night, Thursday night, to a bunch of different hedge funds. Apparently, these hedge funds that bought these blocks of stock, $5 billion worth from Morgan Stanley, they don't really specialize in tech or media or anything like that. They're kind of like a discounter hedge fund, kind of like TJ Maxx that gets a bunch of discounted stuff from Macy's or JCPenney's and sells it at a discount, something along those lines. And so that's what they did. They bought this stuff up. But Morgan Stanley didn't tell them the whole truth of the matter. They did say that they were selling it on a margin call to save some client or something like that. But apparently they didn't tell them like, oh yeah, we have this $5 billion block of stock. We have, $13 billion more in exposure of these same kinds of stocks. And 5 other big brokerages on Wall Street also have almost identical kind of positions and exposures. They did not tell them that part. But apparently these hedge funds, they actually made some money on Tencent Music and Baidu because they bounced back like the next day on Friday a little bit. So they could have made some money on some of these things. And they even actually ended up buying more stock when Goldman was selling at a discount of somewhere between 5 and 20%. They might have made out on some of these. Maybe they lost on some like GSX or whatever. But either way, they're not too happy with Morgan Stanley. Now, this is the real lesson in this. If you don't know how Wall Street works, okay, Morgan Stanley had $18 billion in exposure in these things, right? And so they left this meeting. talking a good game about maybe waiting or whatever, but they're all looking to stab each other in the back because he who sells first sells best, you know. So they offer this $5 billion block of stock. They don't tell the hedge funds that, hey, we got $13 billion more behind it, and Goldman Sachs and Credit Suisse, these guys all have billions of dollars more to sell. Because if they told them that, these hedge funds would not have paid those kinds of prices that they paid. They would either, you know, wait a little bit or even go short the stock ahead of Morgan Stanley. I mean, that's how much backstabbing there is on Wall Street. So they might have asked for a better price or something like that. But usually when somebody offers you a big block of stock on Wall Street and you're not their number one customer, you should probably be a little bit suspicious because they're probably offering it to you and every other, you know, schmo on the street that they don't care about. So while they're offering it to you, they got 5 other guys on the phone offering it to a bunch of other hedge funds. And that's apparently what happened here. Now, if you think because of what Morgan Stanley did, these hedge funds are never going to do business with them again, that's not really true. And even if it was, Morgan Stanley would not care, because if they dump $5 billion worth of stock on Thursday night and these stocks would have fell 20% or more, you know, that's $1 billion in loss that they're avoiding. These hedge funds are not giving them $1 billion in business. So if they can make somebody else eat $1 billion and never have them as a customer again, so be it. You know, there's other customers out there. But that might not even be the case, because a lot of these hedge funds, if they do enough commissions with these big Wall Street banks, the Wall Street banks give them access to really good IPOs, which is kind of like a way to print money for them, easy money. And so Morgan Stanley dumped off that $5 billion Thursday night. Goldman Sachs was dumping Friday morning. And you see that Morgan Stanley dumped another 45 million shares, $2 billion worth of Viacom on Sunday. Why did they wait till Sunday? It says in the news reports that they were waiting for the secondary offering to clear that they did for Viacom. So, I don't know, they're waiting for the check to clear from Viacom or something. I don't know, but you see that there's a little bit of conflict there, because on the one hand, Viacom is a customer and is going to be a customer in the future. On the other hand, they got this stock and they don't want to take a loss and they want to dump it. And so what do you get on Wall Street for being the nice guy like Credit Suisse and Nomura, waiting a few days until they dump their stocks? Well, Nomura says they're going to lose $2 billion from this. Credit Suisse says they're going to lose $4.7 billion from this for waiting around and hoping that, Goldman and Morgan Stanley don't sell the stocks behind their back. And so because of this, the senior risk manager at Credit Suisse got axed along with a few other people. Credit Suisse has exposure to this Greensill fraud, and now $4.7 billion from this. I don't know what the risk manager was doing or what their algorithms are or whatever, but obviously they need to tweak it a little bit. So there's some good lessons here you can learn. One of the biggest ones is the people on Wall Street are not your friends, and if they can make a buck off you, no matter how they do it, they will do it. Now, I remember back a long time ago, I was in Greece visiting my cousin around 2000 or whatever, right before the internet bubble, and he was playing around with stocks and stuff like that in Greece. And I remember he told me that his broker offered him an IPO. And I said, do you do a lot of business with him? Do you have a lot of money in the account? He goes, no, not really. I go, if he's offering it to you and not his really best clients, it's probably a really crappy IPO. But he bought it, and sure enough, I don't know, he lost money on it. I don't know how much he lost. But and that has happened to me also. Now, let me just say that I love Interactive Brokers, and I've had an account with them for 18 or 19 years. But they never offered me an IPO. They never offered me Facebook. They never offered me, any of these big IPOs or anything like that, ever. Not even one IPO, not even a crappy one. But one day, like a few years back, I don't know, 5-6 years ago or something like that, they offered me this Chinese IPO that was like second or third tier Baidu in China, like some kind of search engine or something like a also ran kind of Chinese. I don't know if anybody knows who I'm talking about. I don't remember the name or whatever. And I was real suspicious of it for them to offer it to me because I don't do millions of dollars of business with them or anything. So why would they give it to me? Usually, crap rolls downhill. And so they couldn't sell it to the people that were higher up above me. And so, all right, sell it to the next guy below. Oh, this guy here. So they offered it to me and I passed on it, but I did look at it. And I think from the first day of the IPO, it opened down and just continued lower for a while. So when somebody who doesn't normally deal with you all of a sudden comes out of the blue and offers you this great deal, this, discount on the stocks like the hedge funds got, or what about the proverbial trading system that prints money? If it really did print money, would you be going out there trying to sell it for $1,000 a pop, or would you just keep it quiet and make billions of dollars? The question answers itself. Guys, that's a look at how Wall Street operates. The number one rule on Wall Street is do not lose money. Okay, everything else doesn't matter. You can get new customers. You could pay a few $1 million in fines or whatever if you do something wrong. Just don't lose money. Hope you guys like this video, and I'll see you on the next one. And let's see what other news comes out about Archegos in the future.